Indiacharts publishes Nifty daily video updates, the weekly Elliott Wave outlook, and the long short report covering all asset classes.
You're looking at the daily chart of the Nifty, and the index has reached an important support level that we're going to be watching next week, which is why I'm starting with that as a highlight, where if we draw a trend line from the bottom that we made in May, it fits into a very good trend channel for the entire structure that has followed from there on, with 3 touch points on the top side, and now the third touch point is where we are at the bottom end. So the bottom line now will stand very close to where we made a low just 2 days ago at 14,264. Here the line was slightly lower, but of course it's rising. So on Monday it's going to be exactly at 14,290 odd, and that's very close to this swing low. So this is going to become an important support point that we are going to be watching, not just because of the trend line, but a cluster of supports. For example, if you take a 61% retracement of the last rally, which is the post-budget rally, then that comes in close to 14,310 to 320. We've of course filled the gap. So we filled this gap which has occurred right after the budget. So this gap got filled this week on Thursday, and from there we actually bounced back. Now those who know how to read candle charts will also identify this as a bullish harami candlestick setup, where you have a down bar and then the following day you actually opened up and then you formed a doji. So when you form a doji, which is the opening and closing price are almost the same, but preferably marginally higher on the positive side. So if it's exactly the same, it's a cross, but if it's marginally higher, we call it the harami or the harami cross. So we do have a bullish harami setup, and that along with these supports makes it important. Now of course, which side of the harami you break in candlestick charting, you need that final confirmation. So while you can get a setup, bullish harami patterns have been sometimes devious in nature, which means during downtrends they've occurred and then broken on the downside. So I think this low becomes important once again, and you'd want prices to hold that up. And on the contrary side, if you actually break this low, it would be a signal that something has come to the end, which means this entire pattern that we are seeing for the last year would come to a close, because you would break a key support level that has held for the entire rally. So what should this mean really for investors and traders, and what kind of position sizing they really need to do, is a deep dive discussion we did in the weekend for Indiacharts sessions that we've really started. We spent half an hour, 40 minutes, discussing with Chavan, who's the business head, and we actually go into the market discussion and try to bring out the key points that we have. So that episode is online. You can actually watch it on the Indiacharts website with your insiders login or on the app. And if you're a new visitor to the Indiacharts website, then you can actually get your first month free, is how it really works. So you can get access to that episode. But there's one part which is interesting, which I'll get into, and I also spoke about it on CNBC, and that's intermarket divergences. So to display that, I'm quickly adding the Nifty mid-cap index to this chart. Okay, and what you see now is the Nifty at the bottom part of the screen and the Nifty 100 mid-cap on the top part of the screen. Now, a significant intermarket divergence occurred between the month of February and March, where you had strong performance in the broad market, which is the mid-caps, but the Nifty, as hard as it tried, could not really make a new high in the month of March. And so that's the point where I actually gave up. Till that point, I thought maybe we could continue higher towards, maybe 16,000 or so. But the moment we had this intermarket divergence, have sort of given up in the short term, and the question has been since then whether you'll pull back to 14,200, 100 and again take off to the upside, and that's the question we are really trying to answer over here. So we got the correction which followed this divergence, this weakness, but now will it develop into a larger corrective phase, or are we simply going to see a short-term bounce is the big question. Now you're seeing a similar pattern also develop in US equities. So here we are looking at the Dow Jones Industrials Average, and you can see this big pop-up has occurred in the last 2 days. But when we look at that along with the Nasdaq Composite, okay, so what we see is a more than a month divergence between these two indices, which means the Nasdaq Composite is not making a new high, whereas the Dow Jones is doing so. So we have another divergence there. We've seen post that a small correction, but nothing meaningful. The question really is whether this divergence will result in further downside for the tech index and whether that can then pull down the main index itself. So that's something we're going to be watching out for in the next couple of days. But here's another interesting one which I have discussed in many previous videos, and that's the intermarket relationship between something like oil and Nifty. And I have stated this, that when oil prices fall, they often reflect the weakness in the entire economy, or in what is happening in the financial market, which is the deflationary or inflationary trends. And similarly, rising prices also correlate with rising equity prices. Very different from what you might end up reading in the media sometimes, that falling oil prices are the reason the markets are up, or that rising prices are the reason they are actually down, which completely doesn't work when you look at a medium term chart, right? If you simply look at this chart, you can see this entire decline phase here being associated with a decline in prices. The only time there are divergences are usually in the late stages of the move. So this is also something part of what I discussed on the money control detailed intermarket divergence video. So when you see this last stage divergence where equities have turned and oil is still falling, that's a sign that some trend is likely to change. And if the preceding trend here was down, it was likely to change to the upside. And then eventually both have been going up together. So when we got a correction, say in September and October, you can see that oil prices actually went through a correction as well. And this can be marked nicely as a ABC correction from an Elliott wave standpoint, which means if you marked this as A, this would be B, this would be C. So you would have had a nice ABC correction. And during that phase, we had our own correction once over here. So at this point, which maybe say a third or a fourth wave correction. And then you again had a further first and second wave pullback at the time oil was rising. So again, there's a divergence where the lower low in oil was not supported by a lower low in the indices. But the point here is that when A and C were occurring, when you had those declines, you actually had declines in both markets at the same time. And then from there on, they've been going up, which has mostly been a reflation trade. Now we do have again a divergence here at the highs where oil prices made a higher high when the Nifty did not in the month of March. Some of it was reported due to different news items, and so people will say that, oh, this divergence is not real because, well, there was some news item, relating to in the Middle East, some pressures that, caused that spike, because there were some attacks on some of the oil, refining facilities. But, these news flows will keep coming. For example, the last rally from here could have been associated with OPEC, deciding to keep, production down. But broadly speaking, as you can see, both markets have associated together. So if I take this low point, for example, here, you also find this as the more or less the low point for prices from where they took off. So where are we in this structure now? If you've been reading my posts last week, I mentioned that oil probably started a corrective phase, which means we can mark this as 1, 2, 3, 4, and 5. Okay, and so we have wave A at this low where we complete 5 waves, and we are bouncing back in wave B. Now what we don't know is how long will B be. Will it just be a 1 day, 2 day affair, or will it be like this, a prolonged kind of, pullback? That's something we don't know. But what we do know is after B, we are going to get wave C down. So there's another pressure point building somewhere in the future. Whether it's right away or whether it's after a couple of days is the only thing we'll need to figure out. But while this is going on, there's room for markets to gyrate, both ways once again. So keeping that open, but the only way they can deviate is this can overshoot and then pull back less. That we need to figure out how it happens. Like we saw that happen in the month of October, where the B wave equities actually took off to a higher high, and then you had a divergence. But when none of this we know in advance. What we do know is what's coming in terms of direction, which is up and down, and we really have to figure out the size of what is really going to happen in each of the moves. We've also ended the month of March, so this Feb-March period, sometimes the seasonal correction kicks in because of either the budget or some other reason, or it's also the financial year end. So if you do top out in the month of Feb or March, then sometimes the correction goes on till the end of the month, which is what we've seen. The real thing to see is then whether this continues. So many short-term corrections occur in this period and then pick up from April. There are others then become multi-week or multi-month consolidation phases that can go on, like the ones we've seen, say, in 2015, if we really go back when the BJP election took place. This is all the way back in 2015. They were elected in 2014, and then the rally went on into March of that year, and then from there we saw a corrective phase develop. And so when you have these kind of corrective phases, which are even multi-year, you'll still see it sells off into the end of March, then you have a bounce, then a further sell-off, and so we have to then map that kind of a zigzag movement if it continues to go on that way. And if it's just a routine correction, like we do have sometimes, like in this scenario, topped out at the end of Jan, sold off into the end of March, and then prices picked up again. Which scenario is going to follow is what we should get a clear indication of in probably the coming week. We have 2 days left into the month end, which will also give us many clues on the monthly and quarterly closing for the year. And then we should get a fair idea of where we are really headed for April. So that's all from me for today. Thank you.